Have you ever looked at a tax bill and wondered what's really in it for me? You're not alone. Most Americans hear headlines but don't get the clear picture. That changes today. By the end of this video, you'll know exactly how this bill affects different types of earners, whether you're working hourly, raising a family, running a business, or just trying to make it by. Some of these changes might surprise you, not just in how much they promise, but in how long those benefits actually last. Let's begin with workers in the lower to modest income range. If you're someone earning hourly wages or working in service, especially jobs that rely on tips, this bill has a few game changers. For starters, overtime wages and tips will no longer be taxed, but only if your income falls below a certain threshold. This means more take-home pay for people already living paycheck to paycheck. It's a big move, especially in today's economy where every dollar counts. And it doesn't stop there. The standard deduction also receives a bump, giving you an even bigger cushion before the government starts taking a slice of your earnings. Here's a quick example. If you earn around $40,000 per year as a single worker and don't have kids, your standard deduction currently sits at about $15,000. Under the new bill, it jumps to $16,000. That extra $1,000 lowers your taxable income, which could save you roughly $120 in taxes. Not life-changing on its own, but combine it with tax-free overtime or tips, and the benefit grows quickly. Add in any charitable donations, which can now be deducted up to $150, even if you don't itemize, and your total annual savings might range from $250 to $800, depending on how much you work and give. But while that sounds promising, it's important to recognize that these benefits are not permanent. Most of the perks offered to modest earners are set to expire by 2028. That gives people just a few years to enjoy these savings before the rules could change again. So if you're in this group, the key takeaway is make the most of the benefits while they last, but don't expect them to stick around forever. Middle-class families, especially those with children, may feel like this bill was written with them in mind. And for a few years, it kind of is. Families will see some immediate boosts. The child tax credit rises from $2,000 to $2,500 per child. That's a direct reduction in what you owe the IRS if you have two kids. That's an extra $1,000, 0 cents in savings right there. Plus, the standard deduction for a married couple filing jointly increases from $30,000 to $32,000, again, lowering taxable income and putting money back in the household budget. Let's paint a real picture. Imagine a married couple with two children earning around $85,000 a year. With the increased standard deduction, they'll save roughly $240 just on that adjustment alone. The enhanced child tax credit adds another $1,000, bringing the total benefit to around $1,240 before even factoring in other variables. But there's more. If either parent works overtime or earns tips, those earnings won't be taxed under the same income threshold rules as lower income earners. That's potentially thousands more in untaxed income each year. This family also gains access to something called a mega account. Think of it as a specialized savings and investment tool for children that could grow tax-free if used for qualified expenses like education, a first home, or even starting a business. It's an ambitious tool designed to give kids a financial head start and parents a new reason to save. While it may not be widely used at first, it signals a shift toward long-term wealth building options for middle-class families, something that's been harder to come by in the past. Here's the catch. All of these benefits are temporary. Every one of them sunsets in 2028 unless extended by future legislation. So while these families may enjoy a few years of better refunds or lower tax bills, those savings won't last unless new laws make them permanent. It's a race against the clock, and for some, a bittersweet one, knowing these benefits have an expiration date. But now let's talk about the group that sees the most lasting, structural, and permanent benefits: high-income earners, particularly those who own businesses. While middle-class families are given short-term tax breaks, high earners are getting a long-term tax strategy roadmap. One of the biggest changes is to the qualified business income QBI deduction, which is increased from 20% to 23%. And more importantly, this change is permanent. That might sound small, but it's a huge deal. Let's take an example. A married couple earning $200,000 annually with one partner running a business would see their taxable income slash thanks to this new QBI rate. That alone can save them thousands. Add in the expanded estate tax exemption, which now jumps to a whopping $30 million for couples. And it becomes clear this bill is laying out a wealth transfer plan for the ultra. The alternative minimum tax AMT adjustments are also locked in, offering further relief. What's also interesting is that even high-income families still benefit from the modest standard deduction bump and the child tax credit boost. So they're essentially stacking benefits, short-term and long-term. While someone earning under $40,000 may only enjoy tax-free tips until 2028, a high earner could see permanent changes to their tax landscape, influencing everything from annual filings to estate planning decades down the line. This group doesn't just win, they win in ways that compound over time. The ability to shield more income, pass on more wealth, and avoid future tax obligations is deeply structural. For policymakers and average citizens alike, this is where the equity question starts to heat up. If these provisions are permanent for some and temporary for others, what does that say about how we define fairness in the tax system? With so many credits and deductions floating around, you might assume everyone gets something. Unfortunately, that's not the case. Certain groups, especially low-income individuals who don't earn tips or overtime, might see zero direct benefit from this bill. For example, a single part-time worker making $22,000 a year with no kids, no donations, and no retirement contributions would barely notice a change, that are already paying little or no federal income tax, and none of the new perks really apply. This is an important detail. The bill rewards specific behaviors like working extra hours, giving to charity, or contributing to a child savings account. If you don't engage in these activities, there's not much here for you. And since the bill doesn't expand refundable tax credits or benefits like the Earned Income Tax Credit, EITC, many of the lowest earners are effectively excluded. It's not just a matter of income, it's about participation in the right kind of financial behaviors. That exclusion isn't necessarily an oversight. It's part of how this bill is designed. It's built to incentivize action and promote certain types of financial activity. But in doing so, it draws a clear line between who is eligible for tax relief and who isn't. That raises bigger social questions about how we design policy. Should tax reform uplift the bottom first or reward those already moving up the ladder? It also reveals a philosophical divide. Those who argue for smaller government and limited social spending may feel this bill hits the mark, but those who believe in broader financial equity may see it as leaving out some of the very people who need help the most. Either way, it's important to recognize that some Americans will walk away with nothing, even while others gain thousands. Let's look at this later. Let's zoom out. On paper, this tax bill cuts taxes for nearly everyone, but underneath that surface level fairness is a deeper reality. There are no major spending cuts to offset these reductions. That means the US is adding to its national debt, and future taxpayers will have to deal with the consequences. We're pushing financial relief now, but at what cost later? Another layer involves the rollbacks of key credits like clean energy incentives, university exemptions, and some manufacturing deductions. These might not hit you personally, but they affect the broader economy. Companies in sustainable energy or higher education could lose funding or face higher costs. If you support green policies or believe in government-backed education access, these rollbacks might feel like a step in the wrong direction. And finally, while the bill simplifies a few tax calculations, it introduces new complexities. Phase-out rules, mega account restrictions, eligibility tiers, all of these add more paperwork and confusion to a system that many Americans already struggle with. In trying to reward certain behaviors, the bill may be making taxes more difficult for the average person to navigate. So what does this all mean for you? If you're a middle-class family, you get a temporary break. If you're a business owner or high-income earner, you're walking away with long-term advantages. And if you're already below the tax threshold, the bill might not move the needle at all. Ultimately, whether this bill feels fair depends not just on your income, but on your values. And that's the real takeaway from the Social Security post today. Thanks for watching.